welcome to the deep dive. Today, we're going to really dig into some core ideas in finance and investing.
Yeah, we're taking some inspiration from Bill Ackman's Financial Insights.
Our mission really is to pull out those key takeaways, the ones that help you understand how wealth is built, how to make smarter financial moves.
Without getting totally overwhelmed, right? We want to make these concepts click, make them feel, surprisingly simple.
Simple enough for a lemonade stand even.
Exactly. That's a great place to start, actually, the lemonade stand analogy.
Okay, so picture this. A kid wants to start selling lemonade. First problem.
Money. They need some startup cash. Capital.
Right, capital. So how do they get it? Maybe they sell some old video games.
Okay, so that's kind of like selling shares in their little venture. That's equity.
Or maybe, mom or dad lends them $10.
And that's debt. Simple as that. Borrowing money, they have to pay back.
So right there, you've got the basics of financing. Equity or debt.
And even this tiny lemonade stand, it immediately has sort of balance sheet.
A balance sheet for lemonade.
Sure. Think about what it owns. The pitcher, the lemons, sugar, the sign, maybe the cash in the jar.
Those are assets, things of value.
Precisely. Assets. And then what it owes, like that $10 from mom or dad.
Liabilities. Got it. So assets versus liabilities. A snapshot.
Exactly. And for a bigger company, it's the same idea, just more complex. Buildings, equipment, patents on one side.
Loans, bonds, money owed to suppliers on the other. Okay.
Then you need to know if the stand is actually making money.
Ah, the income statement. How many cups sold? That's your revenue.
Right. Then you subtract what you spent, the cost of the lemons, the sugar, the cups.
Your expenses.
Your expenses. And what's left over? Hopefully, something.
That's your profit. Or, if things didn't go so well, a loss. Pretty straightforward.
But here's the really crucial part, I think. What happens with that profit?
Good question. Does the kid just buy candy?
Maybe. But the smart move, reinvest it.
How so?
Well, maybe buy a bigger pitcher or better ingredients. Or maybe even get a second table, expand the operation.
Putting the profits back into the business to make it grow.
Exactly. Reinvestment. It's absolutely fundamental. It's how small things become big things.
And this is the key point, isn't it? These concepts, capital, assets, liabilities, revenue, expenses, reinvestment.
They're not just for lemonade stands. They apply just as much to, Apple or Google or your local bakery.
The scale changes dramatically. The complexity increases, sure, but the basic logic.
It's identical. It really makes you think, doesn't it, about maybe your own little business idea, how these fundamentals play out.
It does ground things. Okay, let's shift gears a bit. Let's talk about something Ackman calls magic.
Ah, yes. Compounding.
It sounds almost mystical, but it's a core engine of wealth building. How does it actually work?
Well, the fascinating thing is how it accelerates growth. It's not just your initial investment earning a return.
Like getting interest on your savings.
Right, but then those earnings start generating their own returns. So your money makes money.
And then the money that money made starts making more money.
You got it. It snowballs. Which leads nicely to that common analogy.
The snowball rolling down the hill.
Exactly. Starts small, picks up more snow, gets bigger.
And moves faster and faster the bigger it gets.
That's compounding in a nutshell. The growth isn't linear, it's exponential over time.
Which highlights why starting early is so incredibly important.
Absolutely critical. The longer your money has to roll down that hill, the more powerful the effect becomes.
Even small amounts, invested consistently over decades,
can grow into something really substantial, thanks purely to time and the power of compounding.
So the practical advice here is pretty clear.
Yeah, don't wait. That old saying, the best time to plant a tree was 20 years ago.
The second best time is now. Same goes for investing.
Just start. Start now with what you can manage and let compounding do its work over the long haul.
It really prompts a question for everyone listening. Are you actually set up to benefit from this? Is compounding working for you right now?
Definitely something to consider. Okay, so we've talked about building blocks and growth. But investing isn't without its risks.
No, definitely not. And avoiding common mistakes is crucial. Ackman has some good pointers here.
Yeah, a lot of investing errors sort of boil down to a few key things. The first one, maybe most important.
Knowing what you own.
Exactly. Truly understanding your investment. Ackman's big on this. No blind bets.
Right. Don't just jump on something because it's hyped or your neighbor mentioned it.
You have to do the homework, understand the business, how it makes money, its financial health, its prospects.
Which ties into the next point, valuation.
Right. It's not just about if you should buy something, but at what price.
Paying too much, even for a great company, can be a trap.
Definitely. You need to have some sense of what it's actually worth, based on fundamentals like profits, assets, growth potential, not just market sentiment or, hype.
So understand it and buy it at a reasonable price. What else?
Debt. Ackman warns about companies carrying too much debt.
Why is that such a risk?
Well, heavy debt makes a company fragile. If business slows down or interest rates go up, those debt payments can become a huge burden.
Potentially leading to serious trouble, even bankruptcy.
It's a critical factor to check. How much debt does this company have relative to its earnings or assets? It tells you a lot about its stability.
Okay, understand it, value it, check the debt.
Mhm.
What's the last big trap?
This one's maybe the hardest for many people. It's emotions.
The fear and greed cycle.
Exactly. The market goes up and down, that's normal. But panicking and selling when things look scary.
Or getting caught up in euphoria and chasing stocks that are already sky high.
Those impulsive emotional decisions can wreck a perfectly good long-term strategy.
So the key is discipline and perspective.
Discipline and a long-term perspective. Stick to your plan, the one you made based on research and understanding. Stay calm when the market gets volatile. Easier said than done sometimes.
For sure. It makes you think back, doesn't it? To maybe past mistakes you've made, lessons learned the hard way. Reflecting on that can be really valuable.
Definitely. Okay, one more fundamental concept we should probably touch on. It's a core choice in finance.
Debt versus equity.
Exactly. Whether you're funding a business or making an investment, you often encounter this choice.
Let's break it down. Debt first. What is it, fundamentally?
Debt is essentially lending money. You give someone capital and you expect to get it back.
With interest payments along the way.
Right. Your return is usually predetermined, that interest rate. It's generally seen as safer, but your potential upside is capped.
You get your interest, you get your principal back, hopefully, and that's kind of it.
Pretty much. Now, equity, that's different.
Equity's ownership. You're buying a piece of the company.
Correct. You become a part owner. If the company does really well, the value of your ownership stake can go up significantly.
And you might get dividends, too, a share of the profits.
Exactly. So the potential returns with equity can be much, much higher than with debt.
But there's always a but.
There's always a but. The risk is also higher. If the company struggles, the value of your shares can fall even.
Even go to zero. You could lose your entire investment.
It's possible. Let's bring back the lemonade stand one last time.
Okay. How does debt versus equity look there?
If you lend the kid the $10, that's debt. You expect $10 back, plus maybe a little extra interest, low risk, low potential, extra reward.
Right. But if you say, okay, here's $10, and now I own half your lemonade stand.
That's equity. If that stand becomes wildly successful, selling hundreds of cups, your half could be worth way more than $10.
But if it flops after one day?
Your half might be worth nothing. You might lose the whole $10.
So it clearly lays out that risk-reward trade-off. Debt, safer, capped returns. Equity, riskier, higher potential returns.
That's the fundamental difference.
Which means, for you listening, thinking about your own investments, you really need to consider your own tolerance for risk.
Absolutely. How much risk are you comfortable taking for the possibility of higher returns? Are you leaning more towards the relative safety of debt-like investments or the growth potential of equity?
There's no single right answer, is there?
Yeah.
It depends completely on your goals, your timeline, your comfort level.
Exactly. It's a personal calculation.
Okay, so let's sort of wrap this up. We've covered quite a bit of ground in this deep dive.
We really have. We started with those basic building blocks, using the lemonade stand to see things like capital, balance sheets, income statements.
How simple yet universal those concepts are. Then we jumped into the magic of compounding.
And why starting early is so powerful for long-term growth. That snowball effect.
We also touched on crucial investing pitfalls to avoid the importance of research, valuation, watching debt levels.
And maybe the toughest one, keeping emotions in check and maintaining that long-term view.
And finally, that fundamental choice between the characteristics of debt and equity.
Understanding the different risk and reward profiles there.
It's interesting how these ideas, which seem pretty straightforward when you break them down,
really do form the bedrock of financial understanding and building wealth, no matter how big or complex things get.
So, considering that even the most massive financial empires are ultimately built on principles, not that different from running a successful lemonade stand.
It leaves you with a thought, doesn't it? What's one small, concrete financial step you could take today, right now, to start building or maybe just strengthening your own foundation?